The big story today is how global markets and commodities have reacted to the reopening of the Chinese economy. Oil and natural gas and metals, all of these have rallied over demand growth sentiment. Indian markets have gained, the metal pack among the biggest gainers in trade. But how does China's reopening affect India's broader markets? And the question is, will India's outperformance, the kind we've seen so far, continue, given that Chinese equities may appear more attractive to foreign funds? That's what we're discussing today. And to discuss it, let's connect with our guests this evening. We have Siddharth Sanyal joining us, Chief Economist at Bandhan Bank, along with Priyesh Ruparelia, the Vice President and Co-Group Head at ICRA. And Sugandha Sachdeva is also with us, Market Analyst. Great to have you all with us this evening. First to you, Priyesh Ruparelia. Now that China is shedding all its zero COVID policy restrictions and now clamoring to get its economy back in shape after getting clobbered out of shape, which are the sectors you think that they're going to concentrate on? Will infrastructure and real estate be back? Do you see auto sales making a resurgence? And will these spur the commodity markets like steel?
Yeah, good evening, Vikram, and thanks for having me on the show. Yes, in terms of easing of COVID restrictions in China, definitely it would have a cascading effect. And in terms of China's dependence on infrastructure and property sector, we have seen that these two sectors alone account for almost 60 to 70% of its total steel consumption. And auto would be additional 5 to 10%. So these three sectors we have seen in last 9 to 11 months of this current calendar year that growth rates for these sectors, especially real estate, we have seen that real estate has been languishing. Almost 10 to 11% degrowth has been witnessed in China's property sector. And China's property sector directly or indirectly contributes almost 25% to its GDP. So anything that happens in property sector will have a very significant ripple effect on other sectors. So once these COVID restrictions open up, we expect significant pickup in construction activities. Also, Chinese government announced stimulus measures in November month, post which we have seen steel prices in China rallying almost by $50-$55 in last 1 month alone. So the situation in India, if we compare situation in India, we have seen that almost because of this 50% increase, $50 increase in steel prices, domestic prices are currently trading at a discount to Chinese prices because of the 7.5% import duty. And because of this rally, and if we expect these positive momentum, etc., to continue going forward, we expect that steel prices are expected to increase further, which will support Indian steel industry going forward.
So these are about the broader sector. Siddharth Sanyal, do you think the reopening of the Chinese economy is going to come at the cost of the Indian economy? What are the strongest links that you see between the reopening of the Chinese economy and the growth prospects of our economy that everyone has been speaking about, that India could outshine its peers in taking away the global manufacturing mandate from China in time to come? Does that outlook change now with the reopening that we are talking about?
No, I don't see too much of a negative for Indian economy for this particular development at all. Rather, I'd possibly suggest that this will actually take away some part of uncertainty that was prevailing in the emerging market space and in the global economy for a while. And China is actually a significant producer of relatively low cost manufacturing products in the global supply chain, which had got disrupted for a while. So from a more structural point of view, I think this should not be seen as a negative at all. If you look at a very, very tactical point of view and a very near term point of view, there might be some ups and downs in the very near term stock prices, etc. But from a more structural point of view, I don't see that as a negative at all. In the very near term, what happens that to some extent you might see some bit of euphoric movement in some of the commodity prices if China comes back to normalcy, because they are by far the biggest source of demand for a lot of heavy metals and commodities. So that we have to adjust to. But otherwise, I don't really see too much of an issue for the Indian economy over the course of the next few quarters.
All right, Sugandha Sachdev, you heard what Siddharth is saying, especially when it comes to the equities. There might be some upheaval over there and could be temporary. What's your reading? Chinese equities, they've fallen by 2/5 since June 2021. The Indian markets, on the other hand, have had a pretty good run in 2022, and of course, this in relativity. But now if the Chinese economy reopens at a reasonably good pace, and you could tell us what could be a reasonably good pace, then how do you see it playing out on the Indian equities?
Hi, good evening, Vikram. So in terms of the Chinese economy reopening, I think the demand for base metals, China is the largest consumer of all base metals, so that is going to benefit significantly. Apart from that, I think it is likely to lead to a lot of optimism in the market at a time when markets are actually grappling with a lot of concerns. Central banks, all of the major central banks have sounded quite hawkish at their recent meetings, and they have already delivered much higher interest rates. And for 2023 also, they have maintained that interest rates are likely to stay at elevated levels for longer. So this is leading to a lot of concerns about the recession risk as well as slowdown in major economies all over the globe. So that is actually feeding into a lot of negativity in the markets. But then with the Chinese economy reopening, we are seeing a Santa Valley coming back in the markets. And for the domestic equities, if I look at the technical levels, 17,800 mark has been holding quite well for the Nifty domestic indices. In case that holds, I think we are going to see a revived rally towards 18,500 on the higher side. So with Chinese economy reopening, I think a lot of optimism is coming back to the market. We've also seen that dollar index has already slipped from levels of close to 115 mark. There has already been a slide of almost 9.5% from the highs, 20-year highs that dollar index gained during the mid-year. So this also is boding quite well for the domestic equity outlook going ahead for 2023. Besides that, the strong fundamentals of the domestic economy are also boding quite well for the domestic equity outlook. The strong domestic consumption theme, the farm sector is reviving. We are seeing demand recovery back to the pre-pandemic level. So all of these factors are boding quite well. We also have a strong war chest of forex reserves. So all of these factors mean that Indian equities are likely to head higher from here on. But yes, having said 17,800 mark remains a very crucial support area in terms of the technical levels. As long as that is holding, we are looking at higher valuations and higher upside in domestic equity indices from here on.
Yeah, would you agree with what we are saying, especially when we say about what has been already spoken about so much about Indian growth? It has been predicated on the strength of domestic demand, which stands irrespective of the Chinese economy reopening, doesn't it? Priyesh, that was for you.
Yeah, sorry. So in terms of domestic reopening, I would say in terms of domestic demand, we anyways have, I think, seen domestic demand remaining at much higher rate compared to other geographies. If you look at World Steel Association's forecasts, India remains the bright spot among other geographies. China is expected to degrow by 4% this year. India is expected to grow by 6%, and other key consuming countries like South Korea, Japan, etc. are all expected to either contract or remain at a very mild growth levels. So India remains the bright spot for the globe at present, and going forward with these easing of restrictions in China, there were fears in Indian market that China, if such COVID restrictions continue for a long period, it could flood Indian market with its cheaper imports. But with these easing of restrictions, we expect the fear of imports at least to reduce. And Indian steel players, with the rollback of export duty, they are well placed now to export in good volumes in coming months. Though these volumes may not attain the kind of levels we had seen in FY21 and FY22, but at least India is expected to remain a net steel exporter in coming months.
So that's as far as the steel sector goes. Now, Sugandha, looking at foreign capital investments in the recent past, do you see those getting drawn back into the Chinese markets if the growth prospects are stronger there? That's one concern. And if so, how much of that is going to be at the cost of foreign investments in Indian equities?
I think we've already seen since July onwards, we have seen foreign inflows reversing. For the first part of the year and in the first half of this year, we have already seen significant outflows. It was basically flight of capital from the domestic economy because of the rising interest rate environment globally. It was basically the US Fed which was actually jacking up interest rates significantly higher. That led to this capital outflows from the domestic economy. But then, since India is in a bright spot as of now, the domestic fundamentals are quite robust, and we are already maintaining a strong growth momentum. I think the inflows will continue into India as well next year. We've already seen that trend since July onwards, and I think that's likely to continue even as the Chinese economy is reopening. But then I think the fundamentals of the Indian economy are much more robust. We already have that inflation is in control. Inflation has already slipped to 5.88% in the November period. And we are also seeing that current account deficit is also likely to be contained at levels of around 3% of GDP. So overall, the fundamentals bode quite well for drawing inflows into the domestic economy. And going forward also, I think the domestic equity indices are likely to perform well in 2023.
What's your reading as far as industrial production in India is concerned? Because there have been concerns on that front. The kind of growth that we've seen in the equity markets, how well they've done for themselves, don't seem to reflect as far as industrial production and growth prospects there are concerned as well, because the finance minister has gone on record saying that she doesn't understand why industrial investment is not taking place here in India. How much of a concern is that, and this at a crucial time when we need to compete with the best in the world? Siddharth, that was for you.
Sure. I think in 2022, when we had been coming out of the COVID uncertainty, then we were struck with a couple of other uncertainties like the war, as well as high inflation, rising interest rates, and a little bit of concern about the current account and potential shock on currency. Now, looking back, while the war situation is continuing, on the other macro parameters, the situations, the worst clearly seem to be behind us, and we possibly are settling down with some of the in terms of meeting some of the risks that were there in front of us 6 months back. So my sense is that going ahead, this particular scenario might be slightly better. While interest rates are on an absolute level slightly higher, the uncertainty around interest rate trajectory is relatively less. The currencies seem to be better behaved, and that's why my sense is that in terms of the overall investment horizon in the real economy, it might actually be better. In fact, why on real economy? If I extend a similar set of parameters to the financial markets also, for the financial markets or the equity markets also, you get to see India on a relative scale has better policy stability. It possibly has better political stability compared to many other countries. It possibly is clearly a growth outperformer both in the near term as well as medium term. And we are seeing a situation where more and more people are actually shifting from simple bank deposits to a situation where they move more to mutual funds, insurance funds, as well as pension and provident funds, and they are pumping in more money into the equity markets. So structurally, you are seeing newer avenues of investment or sources of demand for Indian equities. So overall, even the valuation is slightly higher at this moment compared to its historical levels, I don't necessarily feel that Indian markets will see the threat of underperformance anytime soon.
About the current valuations in the equity markets and whether we have to be worried about it going ahead. But if all of you are positive about the Indian growth story, I just want to understand, Priyesh, what do you see as the possible risks if the reopening of the Chinese economy is not that much of a risk as perhaps certain reports are pointing out? What do you see as the potential risk to the Indian growth story?
In terms of domestic demand growth, what we have seen is that government capex spending has been the major contributor. Private sector capex has been a laggard in this space. So private sector has to step up on this front, and they have to invest more in terms of overall capex spending, so that steel demand also can be supported because of that. So government capex has been happening, and if there is any issue on execution front because of, say, resurgence of cases, COVID cases in India, And if we are talking about the fourth wave, if at all it becomes a reality, then we could see some slowdown in construction activities, which is the major driver for steel consumption in India. So if that happens, I feel that that could be a near-term risk that we are going to look at.
And also, as far as the last 5 years is concerned, India's managed investments, the kind I'm looking at, life insurance, mutual funds, retirement accounts, hedge funds and portfolio services, they've grown to 57% of the GDP, and this rising from 41% according to a report put out by CRISIL. Do tell us, Sugandha, as far as consistent growth is concerned, as far as investments go, how do you see that panning out in the broad sectors that we are talking about?
So, Vikram, can you please repeat the question? I could not get that.
I'm talking about the data that I'm seeing put out by CRISIL, which is about India's managed investments, life insurance, mutual funds, retirement accounts, hedge funds, and portfolio services put together has seen a growth of 57% of the GDP, and it has gone up from 41%. As far as consistency in these managed investments go, what's the outlook?
I lost your voice. I can't hear you.
Can you hear me now? Is this clear, what I'm saying?
Vikram, I can't hear you. Is this question to me?
Fair enough. I'll come to you in a moment. Siddharth, perhaps you heard that question. Can you answer that for us?
Yes, that's precisely what we have been discussing. A few minutes back. That a lot of money is actually domestic money, including sizable amount of granular retail money, is moving to channels like mutual fund, larger amount of insurance, pension and provident fund, and they seem to be very, very sticky. The investment through the SIP route in the Indian market is gaining momentum and popularity by leaps and bounds over the course of the last few years. Now, these are very strong signs so far as the long-term stickiness of that investment capital is concerned in the domestic market. And minded that India is relatively, not a capital account, completely open, convertible capital account economy. This particular investable fund typically stays here. Now, another factor I'll be talking about, there had been often been a lot of discussion about income inequality in India. Now, while that's a serious issue over the course of the next 5 years or 10 years, and it's a global trend, it's not necessarily in the country itself, but that will also mean that sizable amount of additional investable funds in the hands of some segment of the population, that also keeps coming as risk capital for such markets. So overall, over a period of time, over a 5-year, 10-year horizon, this actually provides a strong platform for the Indian equities to perform in a pretty strong fashion, and that offers me the conviction that there is not too much of a risk on a structural basis for Indian markets to underperform anytime soon.
Segue to a question to Sugandha about the market, and perhaps Sugandha, this is coming to you clearly. I'm asking you about the potential in the Indian market. If one has to capitalize on everything that's happening as far as the Indian growth story is concerned with the reopening of the Chinese economy, and you did refer to the fact that this could be a net positive for the Indian equity markets. If that's the case, which are the sectors that you think could help capitalize on that Indian growth story for investors going ahead?
So I think the sectors that are likely to benefit from the reopening of Chinese economy, I think the metal sector, NALCO. If I talk about basically metal sector, because China is a huge consumer of base metals. Besides this, I think crude oil prices are also likely to see an uptick from here on. So that will actually benefit a lot of sectors, especially the oil exploration sector. So that will also stand to benefit. So these are the two major factors. Besides this, I think the IT sector has been quite undervalued in recent times and has not performed. With the reopening of Chinese economy, I think the IT service sector will also likely to outperform other sectors. So these are the three sectors. Besides this, I think we are very positive on the banking sector overall for 2023, but then that's not related to reopening of Chinese economy. But overall, the banking sector is likely to outperform in 2023. So these are the top picks for 2023.
Do tell us, because Sugandha has brought up the issue of crude oil. If these crude oil prices go up, do you see this as a challenge, Priyesh?
So we have already seen a spurt in energy prices in first 2 quarters. If you see the results of majority of steel companies, Q1 and Q2 both have been pretty average compared to FY22 performance, which was a standout year for most of the steel entities. So in Q3, what we expect is that coking coal prices have softened from the highs of Q1, and that would support the earnings of most of the steel makers. And Q4 also we expect coking coal prices to remain largely in the same range. But if China continues to produce steel at a rapid pace subsequent to this reopening of the economy, then crude oil prices as well as coking coal prices would increase, and that could push up the cost for steel makers most likely in Q1 of next financial year. So Q1 of FY24, we could see some effect of that playing out. But in Q3 and Q4, we expect profitability of steel makers to be much better compared to Q1 and Q2 of this year.
Fair enough. Siddharth, in passing, as far as credit growth is concerned, and we've seen that play out on the bank Nifty as well, and it's had a spectacular run, do you see that continuing? Because that is being brought into question in that RBI report that has been put out, and I'll come to that in a moment. But essentially, what's your reading of credit growth and how the banking sector has fared so far in these inflationary conditions, in these high interest rate regime that we live in?
Well, I think the credit growth that jumped higher significantly over the course of the last 6 months can stay higher for at least another couple of quarters. This is a period when we are seeing that the momentum in the economy, the larger chunk of the economy is actually coming back to a significant amount of normalcy, and they are slightly more confident going back to the credit route more often than not. Now, so I'm not really too worried about the credit growth continuing in the near term. The important factor is possibly in terms from the bank's point of view, how they exactly manage the cost of funds, because there had been quite a bit of rise in interest rates on the part of the RBI. There had been quite a bit of withdrawal of liquidity from the banking system. So in that kind of a situation, if banks need to increase their deposit rates further, that possibly puts some bit of additional pressure on the pricing of credit or interest rate for the loans. So that we need to figure out. But as such, overall, at least for the next couple of quarters, the general demand for credit is significantly strong still.
Factors at this point in time are pointing towards continued economic growth for India, and as far as the global growth story is concerned and India's role within that growth story, it does remain intact irrespective of the reopening of the Chinese economy, according to what our experts this evening are telling us. Priyesh, Siddharth and Sugandha, it's a pleasure having you with us and your perspective on this edition of India Tonight. Thanks for joining us.
Thank you.